And if you want to see what is happening over the last 2 days in the market, stay tuned. Welcome to Smart Investing. I do the market update again today and the one of yesterday because yesterday I couldn't do it. So stay tuned and let's go straight into it. Okay, so let's start with the usual QQQ. I'd say today the market was done and yesterday the market was flat. You can see that we are retracing some of the gains that we saw over the last. You can see that the market is retracing just slightly, not so dramatic. A lot of people are saying the market is plunging again and again. I mean, they are dramatizing, they are just drama queen. I think nothing really important. You can see we are just retracing back only 2.1%. So those who are calling for the market is falling again and this is going to be a nightmare scenario and so on. I told you on Wednesday that we might gap fill this because we have a huge gap up that happened here. And it's highly probable that we're going to go back to the 590 marks on the QQQ because we have to gap fill. It's not an obligation, but usually this is what happens. We gap fill, and after that, before we gap fill, and after that we rally back. So it's more likely that we're going to see that we're going to go to this red line around 490 for the QQQ. Nothing unusual, just pretty normal retracement, and that's nothing to be worried at the moment. The market is still very bullish. I don't see any bearishness in the market. Of course, a lot of sentiment is negative, but the market doesn't look bearish at all. Look at this. It's just you had a sideways market for a few days. You have a small retracement. We're gonna probably gap fill to 490, and then of course, if it break below 490, more likely you're gonna see a retracement to 50%. And that retracement of 50%, I will show you, is the usual Fibonacci retracement. 50% retracement is here, 462. That means we will retrace back 50% of the upside that we had. And that's around 462. But that's probably, it's plausible, I don't say it's not going to happen and it's impossible and so on. It's plausible that we are going to test that level again. But very unlikely we're going to go back to the 400 limit that we saw in April. Also very possible, but very unlikely. Everything is possible in the markets. But here we talk about normal probability of things happening. Okay, so again, just let's remove that Fibonacci retracement chart. And you can see the volume is quite decent as well. So I think we should continue to see the rally. We're going to retrace back to fill the gap. And then the market is going to start and continue its bullish channel. During the holiday season, maybe not, because during the holidays, usually the market trades sideways or retrace. And September usually is not a good month. So let's see if this year September will be a good month. But usually September is not a good month. October is becoming better. S&P 500, same story, you see. We are starting to gap fill, and here we're going to gap fill to the level of 570. Only retracing so far 2.5%. These are the same level as the Nasdaq. So nothing really, like a lot of people are starting to cry again, screaming wolf and screaming disaster and so on, but nothing at all is happening. What is quite unusual is what is happening in the long-dated bull market. You can see that the TLT is the 20 years average maturity of US bonds, and you can see it went down to 83.3. It's almost the low. It actually reached almost the low back of October 2023 when they started to announce they're going to start reducing rate when it was above 5%. So when you see that level of 83, that means the 20 years rate has gone way beyond 5%. Now it's going back to 5%, but look at the 20 years rate. It went to 5.20, close to 5.20%. Now it's a 5.03. That's very unusual to see that happening, and at the same time the market is recovering sharply. Usually when you see rates on the long dated side going up, this is not at all a good environment for stock to rocket. That's on the book, but again, sometimes the market do stuff that is not on the book. We've seen it over the many years that even over the 5 years, 6 years, we've seen many things happening that is not on the book of economics or trading of markets. Then you can see the 30 years almost flat with the 10 years is 4.5%, not all-time high, because we can see we have been close to 5%. We have been close also to 5% back in the 2023 when they announced they're going to start to cut rate. Was around November 2023. And what is quite dramatic for TLT is that those who have been invested with TLT, and that was including me, that is invested after that I understood that this is not going to happen. But look back in 2023, you can see first, November 2022, we had a sharp increase of TLT. Then we have a huge close huge drop of TLT in October 23. And after that, when they announced they're going to cut rate, or start to cut rate at least, they're going to stop increasing rate. It was back October, November 23. Then we had a huge rally into TLT, went to 100. And we thought, that's it. They're going to break out and just recover to 110, even more than that, because we are the lowest level ever on TLT. You can go back to many years ago. You can see that we never see TLT so low, you know. Look, was close to 200. Now we are less than 100. And you can go back years and years and years and years. You see, we have to go back to the years of March 2011, more than 15 years ago to get that level of TLT, you know. So that's very unusual. But what we can say is that those who wanted to play the rebound of TLT for many times, you see, rallied, then recovered, then collapsed back. Then rallied suddenly, then again collapsed back to the lower point, you know. Now the question is that if you are at this very low point, is it a good point, entry point for investing in the long run, or maybe just clipping the coupon of 5%, then waiting the rally in TLT over the long term and having some capital gain? But again, who tells you that the rate are going to stop at 5%? Can go way above 5%, and if it does that, then you're going to go much lower than the minimum of 83 that we've seen back in October 23, you know, when the government actually was increasing rate, the Fed was increasing rate, and they decided finally to stop it. That will be very unusual to see that breaking below that level, you know. But anyway, anything is possible. A movement of panic, or sharp selling on the treasury market from Japan or other big players, that could make a lot of pressure on TLT level. So again, since 2023, almost 2 years, 1 year and a half, TLT has done absolutely nothing, you know, only roller coaster, you know. And those who think that bonds are very safe investment, look at the volatility of that beast, you know, who would go for 82 to 100, from 100 to back to 87, from 87 back to 100, from 100 again back to 85, 85 go back to 93, and then from 93 go back down to 83. That level of volatility for me is almost the same as stocks, you know. It's not safe at all. Safe at all, not at all, you know. This is crazy. The same goes for IWM. If you look TLT, IWM, same story, you know. You see, breakout rally, and then bang, retrace back to there, then rally again, then again you get a sorry. This is IWM, sorry. You get a breakout, many years you get a trade sideways, then you get a breakout when they announce they're gonna maybe stop increasing rate, then huge breakout to 245, then huge retrace back in April, almost to the lows of many years ago, you know, or lows at 170. Now go back to 210, and now again retrace back. This is crazy. You don't make money for the last 5 years on this bit. And I'm been very much invested in IWM. I'm very frustrated. And those of you who are invested in IWM, I understand your pain, you know. This is dead money for many years, you know. This is crazy. Anyway, this is an interest rate play. The same as the 20 years bonds, TLT, it's an interest rate play. Then if the Fed doesn't start to cut aggressively, or start to signal they're going to cut more on the rate side, then you will not going to see this IWM or TLT breakout, you know. You will not see that. It's purely interest rate play. If you look at the VIX went up for the past 2 days quite significantly. It went actually close to 25.69%, almost quite a peak level of last December in 2025. You see, we had that peak here. So it's not normal level, it's out of normal level, abnormal level, but it went to 26, now it retraced back to 21. Still elevated, but not very so worrisome, you know. And you can see the RSI on the VIX is back to neutral at 50. Other than that, we can see that the MAX 7 has held quite well, you know. Look at that. MAX 7 has recovered by almost 30%. And you see, despite the last few days, almost for a week, it's trading sideways. Barely retraced back from the highs of this market rally, or this market rebound. We cannot say it's a rally, it's a market rebound, you know. But we're still some way from the all-time high. We're still 11-12% from all-time high. But MAX 7 is going to be very hard for them to retrace back at least to gap fill to the level of 48, 47. It's possible, and it probably has to gap fill again. But in order to gap fill this gap up, you have to go and break below again the 200 moving average, which I think is very unlikely. It's going to go to the 200 moving average to 49, and then or it breaks below that, then it will go much lower, or it will rebound from the 200 moving average and then continue its rally to all-time high. But I don't think that Max 7 are going to plunge again, you know. Very unlikely. AMD still trading, slightly retracing back from the level of 122. Now we are around 110. Nothing to worry, 110. Even if it goes to 100, fine. I sold some puts, you know, at 105 on the strike. I'm happy to buy AMD for 105 and increase my position again. You know, I don't care, you know. It's good. This stock is going to rocket in the next few years. Everything around 100 you're going to buy is very, very good, you know. SMCI also trading around 40. We wanted to go back to 50 and was pushed back at the 50 level, which is a very, very important resistance level 50. You can see tested 1 time, 2 times, 3 times, many times here. Managed to break out 1 time and then was pushed back well beyond that resistance level of 50 just when it reached the level of 66. Palantir, that's an animal just up there, just oscillating, waiting to find the new direction, whether it's breakout above there or it just retrace back sharply. But Palantir, I don't see how this can go much lower in terms of valuation. I don't understand these stocks. Anyway, if you do understand, leave me a comment below and just tell me how you're trading Palantir, you know, on what basis you are trading these stocks. The Max 7, you can see all of them are doing well, except that Apple has retraced back, of course, because of the tariff talk and the tariff that Donald Trump wants to impose on iPhones not made in the US. And all the tariff talk again on the European Union, where he wants to slap 50% on import of the European Union. So basically, trade war is back on the headline, and that's causing a bit of volatility in the market. Amazon is right around the 200 marks, which is a critical marks for Amazon. We might gap fill and go back to 190, 195, which is not very surprising at all. We are just smack onto the 200 moving average. And 200 moving average, it's a very important support for any stocks, you know. Google rebound from the level of 150. You can see it tested 150 few times. 1 time here, but again 1 time here, 1 time here, 1 time here. Does like 3 times here, 4 times here. Definitely 150 is a critical level for Google in terms of valuation, fundamental valuation. NVDA 130, waiting for the earnings that is going to happen next week on the 28th. That's going to be a very big day for all the AI plays. So stay tuned for next week on NVDA earnings. Other than that, quite a good market. Overall red today, overall red yesterday, but not like so dramatic that people are talking about. Not so dramatic at all. Just a small retracement. We might retrace even more. You can see it start to gap fill. Maybe this one on stocks will go to 195 and then rebound from there to go to all-time high, or maybe test again the resistance level of 241. Other than that, it's quite a good. Despite all the negativity, the market is holding really, really well. If you look at the economic data, this week, Monday, nothing important. We had Wednesday, nothing very important as well. Then on Thursday, we have some job data, continuous jobless claim, 1.9K as opposed to 1.87. So just in line, you know, just slightly over, but not so much. Initial jobless claim, 227,000, 230 expected. Very much in line, so the job market is not being impacted at all by the tariff talk, by the GDP contraction. Nothing at all is impacting the economy. Friday, nothing. Let's see what the AI is telling me on the economic front. Tariff threats. President Donald Trump announced a proposal tariff 25%. Yeah, that's what I said on the iPhone. Impacting Apple negatively. He threatened also 50% on tariff for the European Union. Escalating trade tension. Of course, they voted a budget of 3.8 trillion tax bill and spending bill, raising concern over the long-term US debt. And that's probably why that the market pushed the rate higher on the long-dated bonds, because this level of debt of the US, many think it's actually going to an unsustainable path, you know. The bill includes a 4 trillion debt ceiling increase, crucial to avoid fund crowding by August. Corporate earnings, we have Intrit. Actually, the boss of Intrit went to PayPal, as you know. Share rose nearly 9%, Q3 earning boosting the capital 2025 outlook. Key economic data, new home sales accelerated for that, downward revised to 770,000. But anyway, the real estate market in the US is dead because the rates are so high, you know. Who wants to finance buying a home today at this level of 7, 8% or 9% sometime? PMI increased to 52.1, which is a good news from 50.6, but that's the global PMI. So that means the economy is expanding and we are not expecting a recession, at least from a global perspective, you know. Consumer spending, retail sales in April was only 0.1%. Of course, we are down from 1.7% in March, suggesting a slowdown in consumer spending. Other than that, nothing really on the economic front. On the headline, you can see is all about the big beautiful tax bill and the tax cut that Trump has promised. And of course, the resulting talk about the US debt and the cost of servicing the debt, especially at this high rate of 5% or more. That's quite a big talking point right now in the market. Again, the headlines for the tariff is back. Stock fall as Trump not looking for AU deal. Trump broadened tariff threat against AU, Apple, Samsung import. Apple confronted by Trump demand to make iPhones in the US. So, and again, the US long-term borrowing cost surge over deficit concern. You see, all the headlines we've just actually highlighted is impacting the market, is actually making the market more bearish. But if you look at the market level, I don't see any panic at all. We might be trading sideways for a while. If you have this rate, and especially the long-dated rate, so high, I don't think it's fuel to the rally that we're going to expect. High rate doesn't warrant a rally in the stock market. But again, we never know. Other than that, then if you have anything to tell me about this week market, leave me a comment below. And stay tuned in the weekend because I'm going to do 1 or 2 videos on stock specific that I think is an extremely good opportunity right now in the market. So I invite you then to subscribe, to like, and to leave a comment. Have a great week.